I've spoken before about the economy's misery index, inflation plus unemployment. I've also spoken before about Fermi's estimation technique. It was invented by Enrico Fermi, one of the fathers of the atomic bomb. It is meant to compute things approximately. This time, let's join the two topics together to estimate how low the market can fall when and if a crash comes. Okay? First, let's review the economy's misery index, the sum of inflation and unemployment. When the sum is low, most people are employed, food and gas and homes are cheap, everything is peachy. So voters usually keep the politicians in power. However, when inflation is high and many are unemployed, people are miserable and they kick the politicians out. The most notable time we had a high misery index was in the late 70s and early 80s. Inflation was 12 to 15%, and so was unemployment rate. The economic misery index was almost 30. Not surprisingly, Ronald Reagan won in a landslide, and Jimmy Carter became a one-term president. The most recent time the economic misery index was high was in 2020. Yes, just a year before, in 2019, inflation was low and the economy was flying. So President Trump seemed assured. But in 2020 came COVID and unemployment zoomed. And so President Trump, too, became a one-term president. Now, what does all this have to do with estimating how low the market can crash? Like this. Similar to the economy's misery index, we can also define a market misery index, which is the sum of the market PE ratio, price to earnings, and inflation rate. When the market PE is high, stocks are expensive. As for inflation rate, when it rises, the Fed raises rates or buys back T-bonds, and this often crashes the market. So, when the sum of PE and inflation is high, you better start selling or thinking about it. On the other hand, when the sum of PE and inflation is low, future returns for the market are good, and low inflation means the Fed can print money and so support the market. The market misery index is therefore similar to the economy misery index, but they go opposite ways. When one is high, the other is low, and vice versa. What is the market misery index range? Here it is for the last 60 years. You can freeze the picture so you can see it later on. Over the last 60 years, the market misery index fluctuated around an average of 20, with peaks of 25 to 30 and bottoms of 10 to 15. Anything in between the peaks and the bottoms on both sides had no predictive value, none. But at the extremes, either high or low, boy oh boy, was it ever predictive of the future. For example, in August 1982, at the depth of the recession, with an economic misery index of nearly 30, the market misery index was a dead cheap 13. And this indeed was the bottom of the market and the beginning of the 40-year bull market, which is probably about to end soon. How about the market misery index between then and now? Let's take a look. There was a spike to 29 in 1987, just before the October 87 crash. How about buy point for the market misery index? There were no market misery index buy points under 15 until March 2009, the very bottom of the financial crisis, and a great market buying opportunity it was. What of market misery index selling opportunities? There have been two. One in 1990 with an MMI of 30 and one in 2000 with a value of 32, just before the internet bust. And then, as I said, came the buy of the decade in March 2009 with a market misery index of 10, which is low PE plus low inflation. Now, what is the next extreme market misery index? Why, the most extreme is today. Take a look again. Today, the market misery index is a super high 34, composed of inflation of 3%, at least that's what the Fed says it is, and a nosebleed PE of 31. Ouch! This means that sooner or later, the market can crash and probably would crash, or at least may. When? Nobody knows. But it can happen. 3 months from now, 6 months from now, or 9 months, but in my opinion, it's very likely that the market will decline quite a bit. And then, eventually, after the long decline, will come a market bottom and a great buying opportunity. perhaps better than 2009. What level would that be? Here finally is how we can estimate it by the Fermi method, being approximately right. Since the market misery index is now at a historically high level, it is reasonable to assume that the bottom will at least match the historical low level of 13 to 15. Say inflation will be about 4%, which would push the Fed to start tightening. This means that the PE at the market bottom should be about 11, plus minus, to make together 15 with inflation rate. But how can this help us to compute the crash bottom level? Simple. For this, we must also estimate the earnings of the S&P, and then multiply by the above PE. Now, what about the S&P earnings? These rise over time, but in recession, they fall. For example, in 2019, beautiful economy, terrific market, the S&P earnings were 145. But in 2020, as the economy shrank due to COVID, the S&P earnings shrank too and fell to 97. Next year, 2022, if a market crash indeed occurs, with debt write-offs and economic shrinkage, we can assume another hit to the S&P earnings to a level of about 100, same as in 2020. And if we face a mini depression, to clean up the debt, we may even have S&P earnings below that. Let's take just the level of 100, multiply by the P of 11, and you get an S&P at the bottom of about 1100, which is down 75% from today, and perhaps even 80% down from the peak, since the Fed is still pumping money, so the market may still rise from here. Yikes! To sum up, based on the last 60 years of history, the market misery index today at 34 is higher than it has ever been before. Therefore, it should probably fall in the next market decline, at least the historical bottom, before the market itself bottoms. Assuming inflation of 4%, this gives a rough estimate of S&P bottom of 1100. Of course, this estimate is approximate and depends both on the S&P earnings and the inflation rate. And if the earnings come down only to 110, and inflation falls a bit temporarily in economic crash, because by then nobody has any money and nobody buys anything, and then the bottom can be at about 1500. So the market bottom in a crash could be roughly between 1100 to 1500 as a rough approximation. Yes, the above is not a precise method, but as Enrico Fermi taught us, often it is better to be approximately right than precisely wrong. And if the market does plunge to this level, what would happen then? Why, the Fed will likely panic yet again and print again, as it did in 82 and in 1997 and in 2003 and in 2009 and yes, just 2 years ago in 2020. And that would be the time to buy. If you have cash, then that is. Will you have cash? Only if you consider selling slowly into the rise. That's all for today. Let me know what you think of the above in the comment below. Subscribe to the channel, and if you like it, which I hope you do, tell all your friends so they subscribe too. I'll see you next time, and meantime, thank you very much for watching.